evening, ladies and gentlemen. Thank you very much for coming. It seems like a long time since we last met. It's in fact over 2 months since the last lecture, and quite a lot has happened in the world of economics. And funnily enough, what's happened in the last 2 months has made this lecture seem rather more relevant than it did when I first said I was going to be talking about this. Now, we've had a reasonably good track record at economic forecasting, but I have to say this is one of the things we got wrong. We didn't forecast that this would happen, so I have a certain amount of egg on my face. What I'd like to talk about this evening is how the authorities should control the UK economy in a time of recovery. And if that sounds a slightly esoteric subject, let me just say that it is terribly important because it controls the pace of economic growth, the rate of inflation, the level of interest rates that we receive on our savings or have to pay on our mortgages if we have them, as well as ease with which people can get jobs. And of course, it affects the vitally important social indicator of unemployment. This is probably the most policy relevant of the series of lectures, and I'm glad that various senior policymakers have asked for advance copies. The background to all this is the theme of globalization, which is the theme of my all my Gresham lectures, except the one-off funnies, like the last one last year on transport and the one this year on Ashes cricket and the inverse correlation between economic success and Ashes performance. I have to say that that should be quite interesting, but since the Australian economy is doing a bit worse and the UK economy is doing a bit better, it may be an indication that we get the wrong result in the Ashes series, unless you're an Australian. But the key points of the previous lectures in the main series are critical to the argument. First, the scale of growth, and particularly export growth in the emerging economies, which are super competitive. And I know that's a word we've invented, but it does seem to describe the issue with which we're concerned. Because they have developed very quickly, and often with rather more authoritarian political structures than have evolved in the West, they have not developed the high cost base that we have in the developed economies. So if you look at Singapore and Hong Kong, which have actually overtaken the UK and most other Western economies as well in terms of GDP per capita, they still have relatively low cost bases. Hourly labour costs in Singapore and Hong Kong are roughly half of ours. And they make up the difference by taking shorter holidays and working about 4 months extra compared with us, as well as having much lower taxes. And they have lower taxes because they've got a very efficient public sector. They spend 17% of GDP, roughly, on their public sector, but still have better life expectancy, better education, at least by the sort of rather literal-minded official measures, and better infrastructure than we have. So it's quite interesting that. But they don't have the high cost base that we have, even though they've become developed. And that, I think, creates the challenge, or part of the challenge, for us. We will also have the issue, as far as our own economies are concerned, of having to devalue our currencies to keep up with the Joneses, as it were, in this new competitive world, relative to those in the emerging world. And that will also have an impact on import prices, and particularly on how much things like minerals and energy cost when translated into sterling. Our lack of competitiveness and the difficulty of correcting this through conventional means will constrain the growth in the traditionally West economies in the medium term. Devaluation is the traditional way out when an economy is not exporting enough because of lack of competitiveness. But the scale of possible devaluation is limited by its inflationary effects. This is what we in Cebr have called the new theory of economic growth. And what that means is you won't be able to devalue as much as you want to get the economy back to full employment, or at least sort of traditional rates of economic growth, because you can't devalue enough because of the inflationary effects. You're left with growth being less than you would like it to be. The next point is that inflation is much more driven now by commodity prices and government policy, for example, on housing planning, than by labour costs, as was traditionally the case, and certainly had been the case when I first went into economic forecasting 39 years ago, just before the winter of discontent. Now, as a consequence of these points, we will tend to have a growth shortfall and upward pressure on inflation compared with where we might have been in the past, and we therefore need an economic policy that copes with that mix. The problems are augmented by the fact that investment in skills and other forms of capital is partly endogenous to the economy. Now, that's a techie term, but what it means is that how much companies invest, and to some extent how much people invest, is a function of how much economic performance there is. When they're doing well, they invest more. When they're doing less well, they invest less. And so the ultimate amount of capital and capacity that you have for future growth is a function of how well you've done in the past. It's a sort of case of success breeds success. The critical issue is how we react to all of this. Let me turn now to the current state of the UK economy. The UK economy now is recovering apparently very strongly. Perhaps some of the perception of a recovery is psychological, because the recovery comes after a prolonged period of little or no and occasionally negative growth. In the circumstances, any recovery would look impressive. But even allowing for this, there is what looks like a very powerful recovery currently taking place in the UK. Now, most economic forecasters have a bit of egg on their face on this year's forecasts. And I have to say we have a bit more than average. And since I've drawn attention to CBR's exceptional forecasting track record in the past, it's only fair that we put up with the embarrassment that emerges when we get our forecasts wrong, which we do from time to time. And by the way, the forecaster who never gets their forecast wrong is the forecaster who never makes any forecasts. Actually, getting our forecasts wrong occasionally is a useful learning process. The economy doesn't stay the same, and so the appropriate models for forecasting need to change constantly to keep up with what's actually happening in the real world. And I hope one of CBR's strengths is our error correction procedure, where we carefully analyse our forecasting mistakes and try to see what we can learn from them. And the analysis that I'm going to present for the rest of this evening about what has driven the recovery is the result of our error correction processes, where we've tried to work out what it is that's made the recovery so much stronger than we predicted. We predicted there'd be a recovery, but on nothing like the scale that appears. Now, my first exhibit, which is a bit of a little bit of an excuse, really. It's a bit like a sick note or the dog ate my homework or something like that. And this is a chart lifted from a recent speech by Charles Bean, who's an old maid and Deputy Governor of the Bank of England and a former chief economist, who spoke to the annual conference of the Society of Business Economists, the SBE, on the 22nd of October this year. And he was obviously looking for a get-out clause as well. And he came up with his index that the bank calculates, which is the surprise index. Now, I'll give you a little bit of description for the technically minded. The Bank of England has set up an index which looks at 14 data series and measures the extent to which the outturned data for these series has surprised the consensus of economists' expectations, obviously scaled by the standard deviation for each of these series, obviously. And what this measures is whether the news is better or worse than had been predicted. Of course, one thing that this index might be measuring is how good the news is. The other is how bad the predictions are. My guess in this case is that it's probably both. Now, the blue line on the chart shows what has been happening in the UK compared with standard deviations for the various forecasts. And what it shows is recently the news has been 0.6 standard deviations better than is usual. Remember, you're within a standard deviation on one side or the other about 75% of the time. So we're not on average outside the range of expectation, but nevertheless, it is unprecedented in the period for which they've calculated the index, which goes back to 2006. Now, what's interesting is that the blue line is the UK, the red line is the United States, which is very slightly on the upside, and the green line is the Eurozone, which is also very slightly on the upside. In other words, the UK is out of line with all the other economies in having performed a lot better than the consensus of economists predicted. My second exhibit is two series for business confidence. The top series is for the Institute of Chartered Accountants in England and Wales, ICAW. Paul, there's an advert for you. And Grant Thornton. It's a series of business confidence which we started up a number of years ago, nearly 10 years old now, and I think it's one of the most comprehensive and useful surveys of the British economy. And that looks at people essentially in the finance profession and their views of confidence. And you can see that the results are the highest in the 10 years of the survey. The series at the bottom is something we also started and run for BDO LLP, which shows their poll of polls, where they average all the business confidence surveys and show what they average. And it's a weighted average, again weighted by standard deviations, and normalized so that the things are put on an equivalent scale. And you can see again that the blue line on the bottom is up at a very high level. And what they show is that business confidence has been consistently gaining momentum and is very much in the range of pre-recession peaks. My next exhibit is consumer confidence. And the best index is, of course, the one that we're involved in. I would say that, wouldn't I? It's the YouGov CBR Heat Index. I've forgotten what heat stands for, but it's meant to be something indicating some degree of optimism. And we analyse it with our friends from YouGov, who, of course, work just around the corner from us. And this has also recovered sharply. But there is a difference between business and consumer confidence. The former is close to its all-time high in the UK. The latter is at its highest since the recession started, but the long-term analysis of the longer-running series suggests that where we are now is about close to about its average for the pre-recession period. So business confidence is at a record high, consumer confidence is high compared with any time in the recession, but compared to the longer-term series, it's just average. And what these surveys do show is that a critical factor in the economic recovery has been the unprecedented turnaround in both business and consumer confidence. Now, I have never before, in 39 years of economic forecasting, seen an economy turn around simply by becoming more confident. And what is interesting is that this is essentially a UK phenomenon. It isn't happening in any other country in the world. And that's one of the reasons why the UK is likely to be the fastest growing Western economy over the next couple of years. The other interesting thing about these series is their timing. They all turned around December last year or January this year. And they've all gone up in more or less a straight line since. Now, that's important for some of the attempts to explain what's been going on, because the Bank of England only instituted forward guidance at the beginning of August this year. Now, as you can see from this line on this chart, or indeed on the two I presented on the previous chart, the upturn started a lot earlier than that, and most of it had already happened by August. So although forward guidance isn't necessarily a bad thing, you cannot conclude that it's forward guidance that has turned the economy around. I like the style of the new governor of the Bank of England, Mark Carney, but it's important that expectations about him are not excessive. And you can see that most of the improvement in confidence actually started before he even came over to the UK. This is perhaps the point to pay tribute to the former governor of the Bank of England, Mervyn King, now Lord King. He has been heavily criticised, and occasionally by me, and the BBC, always keen to put the boot in, actually had an hour-long radio programme criticising him a few weeks ago. I think they got their timing wrong, basically, because they said quantitative easing hadn't worked, which clearly looks a rather sort of fallacious comment now. I do think that Mervyn was worried about moral hazard, which is the technical term for the long-term consequences of bailing out failing banks through creating a presumption. If you bail out banks when they fail, you make them behave more riskily because they think if they fail in the future, they'll be bailed out again. That's the theory anyway. And he was worried about moral hazard a little bit too late in the piece when Northern Rock had already gone bust. And he was one of those heavily in favour of placing restrictions on banks post-crisis, when the real problem since 2009 has not been banks overlending, but the problem, of course, has changed completely, and the problem today is banks on the whole don't lend enough, and it's only really in the last 12 months that started to change. But despite these two things, which I do think will blot his copybook a bit, I think of all the people in the economic sphere of public life, he has had by far the best grasp of what's been going on in the economy, which means he agreed with me. And it's important to note that the recovery started on his watch. And I believe that the recovery was largely as a result of the monetary measures with which he was associated, although that's jumping a little forward in the lecture. Anyway, I hope he enjoys his well-earned retirement and gets to watch more cricket, which as a former president of the MCC, he ought to get a chance to do. And of course, it's a passion that he and I share. The current CEBR forecast is that UK economic growth this year will end up at 1.5%, well, we've had most of the year, and next year will accelerate to 2.7%. But I should say even this forecast has a caveat. For example, the econometric relationship between the ICAEW Grant Thornton survey and GDP growth suggests that there will be real quarterly economic growth in the fourth quarter of this year of 1.3%. That's just for one quarter. In other words, an annual rate of 5.2%. If this correlation holds, we'll have to revise up our GDP forecast both for this year and, more importantly, for next year, where the figure will end up at 3% or more. A question which many people are asking is whether this is the wrong type of growth, depending too much on consumer spending and on an unsustainable fall in the savings ratio. And I'm afraid the answer is partly yes. It is not a perfect growth mix. Consumer spending looks to be up by 2% this year, compared with disposable income that has been roughly flat. So the whole 2 percentage point rise in consumer spending has come from a fall in the savings ratio from 7% to 5%. But even on these figures, though the data is a bit erratic and depends on one's view about what is happening to inventories and things like that, I would judge that the role of consumer spending in this upturn is slightly less than in previous recoveries. And more importantly, the survey data suggests that the mix is changing fast now and the recovery is becoming much more business-led than in its initial stages as business investment starts to pick up. Now, the second component of concern is the housing market. It is true that house prices are rising, at least in the London area, as is the price of commercial property. Indeed, our econometric analysis suggests that the property price inflation is a major component of the rise in confidence, and especially the rise in consumer confidence. But so far, all that has happened, even in London, is that house prices, the capital value of houses, are gradually rising into line with the very high prices of property occupation that have already been demonstrated by the rental market. And outside London, the position is even more subdued. There will be a point sometime next year or the year after, when if the recovery continues to gather momentum, property prices will move above the norm. But the main reason for high property prices in London at the moment is not cheap money, it is the shortage of property, which I mentioned in my Gresham lecture in January this year. Until we sort out the UK planning system, which gives too much control of the local supply of property to those who have a strong vested interest in creating a shortage to keep up the values of their own property, we will have excess property prices in the economically successful parts of this country. You have to change the planning system if you want to deal with excessively expensive property. And I'm afraid to say mansion taxes are a silly way of dealing with the problem that the user cost of property is too high. They simply replace one form of excess cost with another. Exports are more of a problem in terms of the recovery's sustainability. Normally, you start a recovery where imports will typically grow faster than exports as demand picks up. Normally, you start a recovery from at least having the balance of payments in balance. We start from a position of fairly large deficit, and the deficit will get larger while we grow much faster than the other developed economies. In the UK, we have been behind the curve in reorientating our exports towards the fast-growing emerging economies, although things have started to improve in the last year, though from a low base. We're way behind not only Germany, which pound for pound is the world's leading exporter, but also other European countries like Sweden and the Netherlands in this. In the set of circumstances where the world economy is led by the super-competitive East, it is highly likely that the balance of payments will prove the long-term constraint on UK economic growth. So until we can improve our export performance, our long-term trend for economic growth is about 1.75% real GDP growth, which is significantly down from where it was considered to be 10 years ago. My judgment is that the trend rate of growth pre-recession was about 2.25%, though Gordon Brown and his cohorts in the Treasury did a huge amount of damage by planning on the basis of 2.75%. Just as an aside, it's interesting that bankers who did a certain amount of damage to the economy had their knighthood stripped off them, whereas the civil servants who in cahoots with Mr. Brown did about twice as much damage to public finances through their overspending policies were actually given knighthoods. It just shows how the public sector rewards its own and discriminates against those found guilty of something as below the salt as working in business. Because the economy starts from a position of being well below capacity, you can get away with above-trend growth for a period. But as the balance of payments position deteriorates, it is likely to put some strain on the sustainability of the recovery. I suspect we can only manage about 2 years before warning bells start to ring. It is fortunate that we only have less than 2 years to go before the next election. The next question is, why has the economy recovered? Well, Charles Bean in his SB conference talk draws attention to the funding for lending scheme and the European Central Bank's announcement of what they call outright monetary transactions, which is a facility they offered, but in fact the very act of offering it meant they didn't actually have to use it to bail out the Eurozone. Basically, they said they print money until they killed off the speculators. And that certainly changed the mood in the financial markets. Financial markets was not really willing to take on the ECB. I think Charles Bean's right on both counts, though the euro problem still remains and will enter the political sphere when we'll see whether the Germans are prepared to bail out the weaker economies in the eurozone on a long-term basis, and whether the weaker countries are prepared to accept a degree of control by the Germans over their public finances. I'm covering the euro issue in my February lecture, so I won't expand on that at this point. Charles Bean, as a public servant, has been very proper in merely referring in the public finances sphere to the fact that there is still further need for consolidation of public finances. As a non-public servant, I'm allowed to be slightly less discreet, and I will be. Actually, if you look at fiscal policy for the UK economy, there is a slight whiff of the goose being fattened up for Christmas, because George Osborne has actually put a halt on structural fiscal adjustment until after the election. There is no structural adjustment of the budget planned for the next 2 years. All the adjustment that's in the current plans is for the years subsequent to the general election. Now, whether or not George Osborne is a good economist is something you can think about. It certainly is clear that he's quite a shrewd politician. However, he's got lucky because the economic growth means that the cyclical part of the public deficit is likely to decline as rising growth brings in additional tax revenues. And he can mask the figures a bit through that. But whoever wins the election will be put under a lot of pressure to put the brakes on and achieve further consolidation in at least the 2 years following. Now, our forecasts are virtually the same as the OBR, the Office of Bad Predictions. I probably should stop making that joke now. For 2017-18, when we think the deficit will be down to 40 billion, which is it's not brilliant, but it's still a lot better than the 150 billion peak. And the debt-GDP ratio should be starting to fall by then. That won't mean public finances are perfect, but it will mean that they are less bad. So one explanation of our economic growth is that surreptitiously, austerity in any real sense of the word has stopped. Now you may say, but when I turn on the radio, I hear trade unions from the public sector and virtually everyone in the public sector saying that they're being shortchanged and not given enough money. Well, just remember that whereas in the real world, people get additional funds by working harder, selling more goods, and raising revenue that way, in the political world, which I still consider to be unreal, although it obviously is real enough for those people who work in it, you get more money by whinging and whining, drawing attention to potential disasters that might happen if you don't get funding, and generally making the situation out to be just short of disaster, but with disaster likely to be just around the corner. So just because they go on the Today programme and broadcast their laments through the BBC doesn't mean these laments are real. It's just the way they raise revenue, whereas we raise revenue by working harder and selling more and doing more positive things. It's a slightly different way of doing things. Now, let me turn to funding for lending. This complicated chart, I think the main thing you need to know is all the lines on the right-hand side are pointing downwards. And they're measures of various different spreads. And the spread is the technical term for the difference between the cost that a particular category of borrowers has to pay and whatever the benchmark rate is. It's normally the rate for government funds. And you can see what this shows is that since the funding for lending scheme was announced on the 13th of July 2012, the cost of borrowing by banks, which have now become nearly as creditworthy as their customers in some cases, the cost of borrowing by banks has reduced. Let me just tell you what the official description of funding for lending is. The bank and HM Treasury launched the Funding for Lending Scheme brackets FLS. On 30 July 2012, the FLS is designed to incentivize banks and building societies to boost their lending to the UK real economy. It does this by providing funding to banks and building societies for an extended period with both the price and quantity of funding provided linked to their lending performance. So it's a highly incentivized way of trying to encourage the banks to lend more, and it seems to have worked. Now, the final thing that we think has been driving the revival of business confidence and consumer confidence, which we think in turn has driven the recovery, is the housing market. It's important to note that the housing market is very closely connected to the ability of people to borrow. And one of the things the FLS scheme has done is it's made mortgage availability very much easier. And mortgage rates have fallen. You could get a 2-year fix now for about 2.5%. You can get a 5-year fix for about just over 3%. Now, a year and a half ago, you really couldn't get anything other than the very short-term fix for anything much below 4. So both the price and the quantity have become much more attractive. And as a result, mortgage lending has picked up, although by nothing like back to boom time levels. So the housing market has picked up, and that has been one of the things driving the revival of consumer confidence, as well as the revival in the construction sector. So I think we have to conclude that quantitative easing, QE, has been a success and a critical factor in the economic recovery which we see today. Without it, we might just have had an anemic recovery, but nothing as strong as the recovery we do have. And perversely, it might have actually had to rely even more on the consumer. But it is important to take two things into account. First, QE is only operated with a delay and has taken time to have its effect. It was announced in July, or QE started in 2009, and the FLS scheme started in July. And it's only now that it's really starting to work its way through. The second thing is it is rather addictive medicine, and it will prove very difficult to escape from. Now, the good news is it doesn't look as if the economy is going to need any more QE in the present economic cycle. The government's banking reform bill is likely to come into effect in early 2014. This, in conjunction with Basel III, is likely to mean essentially that banks will have to set quite a lot more money aside as a safety net to match their lending. And this means that their lending will be constrained as they absorb the implications of the reform. In turn, it means that over the next 5 years, there's unlikely to be so much money around that overfunding, which is the technical term for reverting QE, will be required until about 2018, which is a while away. One of the problems of getting out of QE is that it's only when it's wound back that you discover the true cost. In the UK, QE has happened through the through the Bank of England buying government bonds at prices which are artificially high, both because of the state of the economy and because of the distortion to the markets that the bond buying programme represents. And when QE is unwound, the Bank of England has to sell the bonds back at prices that are pushed down by the opposite mechanisms. So buy high, sell low. It's not a sort of good thesis that's not a good model for making a profit. The likely loss on the bonds will be about £7 billion, which we'll all have to pay off in our taxes, if they are redeemed at par value, and possibly nearer to £40 billion if they're redeemed at market rates, or the predicted market rates at the time. But I would guess that the likely timing of the ending of QE or the unwinding of QE is going to be sufficiently far into the future that the majority of bonds will be redeemed at close to par, in which case it will be the 7 billion figure, which is the most accurate measure of the cost, and not the 40 billion that you may have seen in headlines in some of the newspapers. Let me turn now to something called forward guidance. This is the guidance from the Bank of England that they will not raise bank rates or unwind QE until unemployment has fallen to 7.0%. Last Wednesday's figures showed that this measure of unemployment had already fallen to 7.6%. And if it continues to fall at its current rate, it will reach 7.0% in the second quarter of next year. But if growth accelerates, as some of the business owners are indicating, then we could be there by the first quarter of next year. Now, there are some various overrides on the forward guidance. First, if it looks as if there are threats to the inflation outlook that might push them in the medium term above 2.5%. Second, if medium-term inflation expectations become unanchored, a rather interesting naval metaphor, which doesn't quite have much meaning to me. And third, if there are threats to financial stability identified by the Financial Policy Committee that cannot be dealt with by other means. So they have given themselves a few escape clauses. I think the bank got a bit unlucky in its forward guidance because it was specified terms of unemployment when the unemployment rate had been stable for 4 quarters and was not expected to adjust quickly. And it's only after the guidance was issued that we discovered that, in fact, the unemployment rate had fallen quite sharply, even when forward guidance was issued, and looked likely to be starting to fall at an accelerating rate. You're very familiar with Heisenberg's uncertainty principle, which is the scientific name for Murphy's law, or Sod's law. Any series that starts to be observed normally starts to misbehave. Well, it does look a little bit as if forward guidance and the unemployment figures fall into this category. The claimant count, which is a more accurate monthly measure of unemployment, although it is subject to distortion because it's affected by things like changes in benefit policy, fell by 0.4 percentage points between July and October and is already down to 3.8%. And if the broader measure falls at this rate, it will reach the 7.0% target in Q1 next year. Now, I would argue at the moment, therefore, there's very little clear idea about when base rates will start to move. When forward guidance was announced, the Bank of England thought that they would not be raising base rates. They thought they were giving advice that base rates wouldn't change till 2016. That's what they said. And now they discover that they've had to shorten their time horizon from 3 years to somewhere between 3 months and 6 months. That's a pretty extraordinary change in the forecast. And is one of the reasons why, as I say, they may have been a bit unlucky. Which is why we need a broader anchor for policy. Now, the concept of targeting money GDP, or technically the growth rate in real GDP plus inflation, I mean, although it's compound interest and so on, effectively it's the rate of growth of prices added to the rate of growth of GDP. It's been around for quite some time. It was put forward by 2 Nobel Prize-winning economists, Sir James Mead and James Tobin, separately, one in the UK, the other in the US. In the UK, it's been most strongly supported by the most eminent of the economic commentators, Sir Samuel Britton, most recently in his Financial Times column on the 12th of July this year. And many commentators around the world would seem to be moving in favour, including the former economist and current business secretary, Vince Cable. The idea is that instead of having a target for inflation, the Monetary Policy Committee should have a target for the growth in GDP in cash terms and use that to guide their movements in monetary policy and particularly interest rates. Now, my judgment is that in normal times, when the trend rate of GDP growth is predictable and close to past experience, inflation targets that we currently have are probably more manageable than money GDP targets. But at a time like present, when we've had the shock of globalization, an unpredictable change to the growth trend, and also an unpredictable boost to inflation from the rise in commodity prices associated with globalization, and from the likely devaluation, because remember, there's no real economic solution for the UK that does not involve a fairly considerable devaluation, at least against the emerging economies, and maybe against some or other of the Western economies as well. So that will boost inflation. So you've got higher inflation and less growth. You really want a broader measure than just simply an inflation target. So inflation targets have been rather discredited by the fact that since 2005, inflation has been, for all but 2 very short periods, above the target, and for quite a lot of the period, outside even the 1% either side range in which the targets were set. Now, I think what we've actually had is probably something close to a surreptitious money GDP target operated by the MPC anyway. But of course, it's given little indication because it's not been admitted publicly. Forward guidance was an attempt to try to provide a bit more information about what policy was all about. But as you can see, it has been less successful in current circumstances because it has the target which was set there has also proved to move slightly differently from expectations. Now, money GDP targeting is not without its own problems, which is why in more stable times I probably wouldn't recommend it. The biggest of these is that the data appear late and are subject to considerable revision. More fundamental are the questions of what specific targets and bands to choose and how to cope with past undershoots or overshoots. My current target number would be 5% growth of money GDP in cash terms with a band of plus or minus 1%. I would be flexible about coping for under and overshoots, depending on their reason. But the most crucial thing is that I would be fairly lax about overshoots that didn't appear to be making inflation become endemic. It's when inflation looks as if it's going to become a persistent problem. That's when the costs of getting rid of it become absolutely excessive, and that's what you really want to avoid. So that's how I would go about it. So what does all this mean? I've set out a broader framework for Monetary Policy Committee targeting that I believe would provide a better framework than either the bank's unemployment-based forward guidance or the inflation target which we currently have. Now, what does all this mean for interest rates? Well, I explained in my December lecture last year why I believe that the long-term trend for interest rates around the world was that they would be in a lower band than previously because of the scale of Chinese savings, which are currently 6% of world GDP, 50% of Chinese GDP, and Chinese GDP is now 12% of the world, so their 12% GDP means they add a big boost to world savings and have moved up the world savings ratio from about 21% to about 25%. The excess of savings will hold long-term interest rates down compared with where they otherwise be, although they will still move up and down cyclically, of course. But given that the UK is facing a rapid recovery, starting from a base position where the balance of payments is already in substantial deficit, and growth that's too rapid would, because of our weakness in exporting to emerging markets, worsen this balance, we do run the risk that excess growth would lead to a currency collapse that would in turn cause inflation to rise unsustainably. Money GDP in the current quarter is already rising faster than 5%, and this is likely to continue into 2014. So to prevent the risk of too rapid a fall in the exchange rate, it would make sense for the Monetary Policy Committee to move relatively early. My recommendation would be that if the growth acceleration for the current quarter that seems to be taking place, judging by the business surveys, is happening, in which case unemployment will hit 7.0% by Q1 of next year, there will be a strong case for preventative action at the February 2014 Monetary Policy Committee, which is when they next present an inflation report and redo their forecasts. And I would recommend that they have a 25 basis point increase in interest rates at that stage. I don't think that this will signal a return to high rates, but rather that an early movement would actually lower the next likely peak in rates by bringing the growth to a pace that's sustainable and by sustaining financial market confidence. I'm looking for the bank rate to be around 3% on average through the cycle, which is still low by past standards. And by the way, the rise from the present 0.5% to 3% probably shouldn't mean an equivalent rise in mortgage rates, because I would expect spreads to be compressed as this happens. Now, monetary targeting is properly a subject to be proposed by the Chancellor and ratified by the Treasury Committee of the House of Commons, but it is inconceivable that it could be put forward without consultation with the new government. In conclusion, can I just say how flattering it is for us Brits to have one of the world's preeminent central bankers accept the offer to work in this country. I'm sure we all wish him the best of luck with his remit, however it is specified. My next lecture is horribly soon, in the same place at the same time, on Wednesday, the 11th of December. The slightly provocative title is "Was Karl Marx Always Wrong?", which I don't intend to analyse in textual detail. Karl Marx predicted that what he called technically the exploitation of workers through creating a labour surplus leading to compressed wages and rising profits would be a permanent condition of capitalism. Well, it didn't happen for the first 100 years after he predicted it, but it is happening now. The lecture is going to look at what extent to which this is a problem, and whether any attempts to solve it would make matters worse or better. I guess the most provocative bit of it is I'm going to try and do an analysis of under what conditions the exploitation of workers actually works to their advantage by leading to investment and faster long-term growth in wages that very soon makes them better off. Obviously, that can't happen in extreme cases because then they'd be paid nothing. But there must be some circumstances in which it does look like a better thing than the alternative. So this will be the argument in favour of exploitation, which should be interesting. So I look forward to seeing all of you, or at least a lot of you, in 3 weeks' time. Until then, as ever, thank you very much for turning up, and thank you very much for listening. Thank you very much indeed.